Welcome, everyone, to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And Jim, I want to ask you about financial advisor attrition rates because, I was just thinking about how we haven't lost any clients in a long time. And it made me wonder, how does that compare to others? So what does ChatGPT tell us?
Yeah, just a quick, question into ChatGPT says what's the average amount of clients that an advisor loses in a year? And it says the average attrition rate is 10 to 20%. Does that seem like a lot?
It's huge. It's like you go to AT&T and then you switch to Verizon for a promotion and then you go to T-Mobile.
Right.
So every couple of years, that's like what's happening here with the people switching advisors.
Yeah, and even if we get a little more specific and say, what about the top 1% of advisors? So the guys that are supposedly doing it right, they still have an attrition rate of around 5%.
5%.
Significantly better, but 5%'s a pretty healthy number, I think.
Yeah, a big number, in other words, yeah. So I can't wait any longer. The suspense is killing me. What is our attrition rate over the last 5 years?
So we went back and looked over the last 5 years. Our attrition rate is 0.7. So not even 3/4 of a percentage.
Yeah. So I think we're doing some stuff right.
So we're doing some stuff right. Yeah. I think that's cool when you compare that to the rest of the world.
Yeah. Good job, Jim.
Thank you.
Good job, Preston. Yeah. It's so since Preston signed on, we're at 0.7.
Yeah.
But before that, who knows?
Yeah, who
right?
knows what it was then, right?
Okay, Jim, today, today's Monday, May 12th, and the last month has been a wild month. We had the market bottoming like on April 8th or April 9th, whatever that Monday was, right?
Yeah.
So since then, it's practically gone up every day. Big time surge here. And now we're a fair amount above where we were on the tariff announcement day. What was that? Liberation Day.
Liberation Day. Yeah.
Okay. So it's a good time to talk about risk, right?
Yeah, it really is a great time to talk about risk because, man, we had a lot of phone calls from people back when things looked bad and things were gloomy, and it seemed like every day there was a new announcement that scared somebody about the market and where it was going. And that is not the time to make a change, right? When we're feeling our worst, when we're most afraid is almost always not the time to make a move.
Right. And, we did, I think we did a pretty good job communicating that. We did a 20-minute episode, an emergency session, right?
Yep.
And it was on that, I believe it was on that Monday, if I'm not mistaken, the Monday morning.
It was definitely Monday morning, yeah.
Yeah. And so we put that up on YouTube right away. We had a text blast that went out to the entire client base. And in that message, we were trying to convey, if you're younger, if you're aggressive, if you're opportunistic, if you have cash that you're sitting on, now is the time to try and think about being opportunistic. We can't just put a blanket statement saying you should buy. We're just thinking backwards now. But this is our way of communicating to everybody, not only don't panic, but also think about your situation and can you use it as an opportunity. So I think that was a good message. Right?
Yeah, the timing of it worked out pretty well, actually.
Yeah, because that was the bottom, actually.
Yeah.
You can't time the bottom, right? So yes, we had people that were very nervous leading up to that, who are still nervous now. So it's time to reevaluate our risk. And so when we have clients coming in every day as for review meetings or just an ongoing client meeting, we always have this page we ask you to go to prepare for the meeting. And so you can see clearly here, step 1 is to take the risk quiz. So Jim, let's take the risk quiz, okay? All right. So I'm going to fill out my name and my age, my income level, the size of my portfolio. And so those are some baseline things that are good according to the regulations that we have to know. But now the real, subjectivity, the real art of it comes through. So, Jim, why do we care about when you need money?
Those are so many of the conversations we have when we're talking about risk is how long, when do we need it? What is our time horizon? Because what if we needed money in the depths of the April lows that we saw? Well, now we're a forced seller at a really bad time. So time horizon is a really important thing to keep in mind.
You kind of think, you look at the menu here, So do we need money now or within the next 2 years, or 2 to 5, 5 to 10, 10 plus? Kind of works out to different risk levels. If we're taking money right now, we need to have some safe money. We need cash, right? It needs to be cash, money market, T-bills. If it's money in the bank, that's great. High yield savings, or if it's at Schwab, there's T-bills and money markets that we can use right now, like around 4.2%. But to contrast that with 10 plus years, in 10 years, you might not remember, you probably won't remember April of 2025, right, at all. If someone mentions Trump and tariff tantrum, maybe that would remind you. But in 10 years from now, it's not going to matter. And so why do we need to be selling today for money that we don't need for 10 years from now? That's the idea.
We have a long time for that money to be able to recover, absorb whatever's going on in the market. So.
Yeah. Most, actually, we were down 21% on that Monday morning, right? That was technically bear market territory, although it never closed in that minus 21% levels. And so technically, no one's going to consider this a bear market. But it was minus 20, which is the definition of a bear.
Yeah.
And so when you have a bear market, which ultimately we're just on the edge, usually the portfolio would be fully recovered within 2 years. Okay, and so that's why we talk about having 2 years of cash, potentially. In this kind of a questionnaire. Now we're not back to all-time highs yet. Okay, so we're still down a little bit from February, but year to date, it's looking pretty good.
Yeah.
Okay. The next question is, how much investment experience do I have? Obviously, if you're a new investor, you've never been through a bear market, right? Whereas Jim and I have been through like a million of them at this point. Okay.
Feels too many.
Let's think about this. Okay. 2001, down 55%, or we'll say the internet bubble down 50 plus %. 2008, 2009 down 55, 59% or something. In 2015, it was a near bear market. In 2018, it was a near bear market. In 2020, it was down 35%, but only for a month. In 22, it was down 27%. And now we just had this 21%. So like 18, 20, 22, 25. That's a pretty high frequency rate, It's like almost too frequent, okay? But if you have experience like Jim and I do and like Preston does, right, we can use history as a guide, okay?
Yeah, you understand volatility. You understand that stocks can have big swings. Bonds typically don't have as much. So it makes sense to know and your comfort level with each of those different types of investments.
And check the investments you currently own or have owned. This is kind of like a regulatory question, but here's the two that we really like to focus on here. Okay, so in the last 3 months, the market drops by 25%. That's squarely, in the depths of a bear market. And your investments did the same. What's your move? Do you sell all? Do you sell some? Do you do nothing, or buy more shares? So if you're thinking I'm going to sell all my shares, then you shouldn't be invested aggressively. Period. Like this is a tell for us right here. Sell some, right? Again, you're leaning conservative in terms of the risk tolerance. Do nothing. That means to us that you're willing to, you understand the ebbs and flows of the market. You realize it's going to come back. You have that experience. You have that tolerance. And buy more shares. Now we're talking about those opportunistic people, like we were mentioning in the emergency podcast we did. Okay. Anything you want to add to that, Jim?
No, I mean, I agree that I think it's a great question, and it's a good, to actually visualize. And this is why we're bringing this topic up now, is because we just went through a bad market. So you can feel the pain is kind of fresh, right? So that's why it's making this a really good time to have this conversation.
Okay. And the last question is, we're presenting some made up scenarios where you have 5 choices based on average annual return, best case scenario, worst case scenario. I don't love these choices. I don't love any of them particularly, but you can get the idea. Choice A would be the most conservative choice. The average annual return is 3%. The best case scenario, you make 10. The worst case scenario, you lose 5. Whereas choice E, the average annual return is 8%, the best case scenario is 42%, and the worst case is 25. And so, a lot of people end up with choice C, right?
Mm-hmm. In the middle.
Yeah, in the middle. So this would be like a balanced portfolio where you have an average return of 6%, you can make 27, but you can still lose 16. And so, a lot of people would pick choice C, especially if you're retired or in that retirement red zone, a few years before retirement. So between this question and the prior one, how are you going to respond to a market drop? We can really figure out where your risk tolerance needs to be for the portfolio.
Yeah, really helps us zero in on where your comfort level is.
And you should really do this every year. Okay, your answers might change from time to time, but just because you choose, maybe a couple of aggressive answers here doesn't mean that we're going to make your portfolio aggressive. We're going to talk it through and kind of fill in the gaps.
Very true. Yeah.
All right, Jim. So considering what happened in the last month, just because we've had this big rebound doesn't mean that we're out of the woods, right?
Right.
Because there's still this looming, 90-day, deadline, right? More negotiations coming with China, and having the experience of seeing the way Trump works, like he could just make some announcements, and now all of a sudden the market is heading for a double bottom pattern where we're headed back to the April lows.
Right.
So I'm not saying that's what's going to happen. I don't know. No one knows. But I think it's important, given that we've had this rally, this is your chance to change your risk if you're feeling differently now.
Yeah. If you weren't comfortable with the volatility we saw, like you said, gave us an opportunity to make adjustments at a better price now.
All right, Jim. I just thought of this. We didn't script this, but I'm going to ask you to give ourselves a grade over the last month as financial advisors.
Okay.
All right. What do you think?
I mean, hindsight's 20/20, right? But I actually think we did a really good job. We had a lot of conversations with people. We made ourselves available. For every time we had one of these risk conversations, it was time horizon. When do we need the money? How much do we have saved? Does it cover us for our time of need? And then people who still weren't comfortable and wanted to make a change, we always made changes on the margin. We didn't go from all in stock to all out stock. We'd say, well, maybe we don't want to be 80% anymore, equity. Maybe we want to move to 60. And every conversation I had, I think somebody was able to say it felt like a good compromise.
I agree. I'm going to give ourselves an A-. You can never be an A+ in my book, right? And we could always be a little better. But I think we did some really great things, like you said, right? When people were calling in to sell, I was encouraging them to wait until we saw a snapback, and then we pulled the trigger a few times. And I say, don't sell down in the hole. There's always going to be a chance to get the rebound, and that's what we have now. A very strong rebound. I think our message to people being opportunistic was excellent. I think that we were trying to purchase in for those folks, right, at the lows. We probably could have been more aggressive about it. So could have done a little better by being more aggressive for those people that were looking to buy. We did a global rebalance for all of our clients on that Monday morning. So that means if you have that 60-40 portfolio, and so Jan 1, we were 60-40, and for the first quarter, bonds were up nicely, and stocks were down terribly, right? Now we came in, let's say the stocks were at 60%, now they're at 55%. So it was a 55-45 portfolio. We're selling the bonds into strength, purchasing stocks at the low. So I really was I was really happy about that. And then you said, making changes on the margin. So when people are concerned, we don't just put them in cash. We say, hey, right now you're at an 8, let's go to a 7. Right now you're a 6, let's go to a 5, right? That kind of a thing.
Yeah.
And I think that scratches the person's itch for feeling like they're making a change, feeling like they're making a difference, but also not giving up on the future.
Yeah, I agree.
Excellent. Okay, well, if you would like to reevaluate your risk. This is how you do it. peakwm.com, click on existing clients, and then click on the risk quiz, or reach out to us at Nick at peakwm.com, Jim at peakwm.com. And if you are looking for a second opinion, reach out to us at peakwm.com. You can schedule online.